Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of company reports. You might think it's just numbers, but we will see how it tells a story about a company trying to bring new medicines to life, sometimes with more success than others. Grace Therapeutics Inc. is back with their quarterly report, and buckle up because we are diving deep into their financials, their struggles, and their hopes for the future. This is not just about profit and loss, it's about the real-world impact of clinical trials, drug development, and the constant need for funding in the biotech world. First off, let's get the basics out of the way. Grace Therapeutics is filing their quarterly report, and they are confirming they have met their filing requirements. This is good housekeeping stuff, making sure they are playing by the financial rules. Now, a key detail here, they identify as a non-accelerated filer and a smaller reporting company. This tells us about their size and how rigorously they are scrutinized compared to the giants of Wall Street. It means they are still growing and perhaps not yet subject to the same intensive reporting as larger, more established companies. Here is a snapshot of ownership. As of mid-November 2025, there were just over 14 million shares of common stock out there. This number is important because it affects how much of the company each share represents and influences earnings per S-Hair calculations. This section is filled with what the company hopes will happen. It's like their wish list for the future. They talk about developing drugs for rare diseases, aiming for better drug delivery, and hoping their main drug candidate, GTX-104, will get approved. They also mention other drug candidates, GTX-102 and GTX-101, but the language here suggests they are not the top priority right now. They are openly stating these hopes, but also warning that reality might be different. This is standard practice to manage expectations and cover themselves legally. This is the core of their strategy. They aren't inventing brand new drugs from scratch. Instead, they are taking existing medicines and trying to make them deliver better results. Think of it like taking a car and adding a supercharger or a smoother suspension. They want to make drugs more effective, faster acting, with fewer side effects, and easier for patients to use. This can be a smart way to enter the market, leveraging the known safety of existing drugs to speed up approvals. Their star player is GTX-104. This drug is aimed at a serious condition called aneurysmal subarachnoid hemorrhage, or ASA. It is a type of stroke caused by bleeding in the brain. Right now, the main treatment is an existing drug, nimodipine, but delivery and side effects are a problem. GTX-104 is an intravenous version of nimodipine, which they believe will be much better. They hope it can help manage blood pressure issues related to ASA. This is a clear statement. GTX-104 is their main focus. Everything else, like GTX-102 and GTX-101, is on the back burner unless they can find more money or partners. This is a crucial strategic decision, concentrating their limited resources on what they believe has the best chance of success. GTX-102 is aimed at ataxia telangiectasia, a rare genetic disorder that affects motor skills. They believe this drug could help manage its symptoms. And GTX-101 is for postherpetic neuralgia, a type of nerve pain that can linger after shingles. This is a topical spray they are developing. This is a recurring theme for most biotech companies. They are burning through cash and need more funding to keep going. They mentioned having enough to last about a year with their current plans, but beyond that, they will need to raise more money. This is always a critical point investors watch closely. This is the part where they list all the things that could go wrong. It's important to understand these risks because they are the real challenges the company faces. This is a huge red flag. Their entire future seems to rest on GTX-104. If it fails, the company could be in serious trouble. This is the harsh reality of drug development. You can do everything right and still fail. The money, time, and effort poured into trials might not lead to a product. Even if they get a drug approved, they need a way to sell it. They either build their own sales force or partner up. Failing to do either means no money coming in from sales. They don't make the drugs themselves. They rely on outside companies called contract manufacturers. If these manufacturers mess up even a little bit, it could stop the whole drug development process. Now let's get into the numbers. This is where we see how the company is actually performing, not just what they hope to do. This is like a snapshot of the company's financial health at a specific point in time. It shows what they own and what they owe. As of the 30th of September 2025, they had about $16.8 million in cash and cash equivalents. Compare this to the 31st of March 2025, when they had over $22 million. That is a drop of about $5 million in just 6 months. This shows they are spending money, which is expected in drug development, but it also highlights their need for more funding. This number, over $41 million, likely represents the value of patents and drug development rights they own. It's a significant part of their assets, showing the intellectual property is a key value driver. Goodwill, at over $8 million, often comes from acquiring another company or valuable assets. Here, it suggests past strategic moves that they believe added value beyond just the tangible assets. Their total liabilities are around $3.7 million as of the 30th of September, 2025. This is relatively low compared to their assets, which is generally a good sign. This also shows a decrease from about $66.6 million in March 2025 to $62.8 million in September 2025. This reduction is mainly due to the net losses they are incurring, which eat into their equity. This is the income statement for the period. It shows their revenues, expenses, and ultimately their profit or loss. This is where the bulk of their spending goes. For the 3 months ending the 30th of September 2025, they spent about $568,000 on R&D. Compare that to the same period in 2024, where they spent almost $3 million. That is a massive drop of over $2.4 million. This likely reflects a shift in focus, perhaps completing a major trial for GTX -104. The 6-month period shows a similar pattern, with R&D expenses dropping from over $5.6 million in 2024 to about $1.5 million in 2025. This is a significant cost reduction, which could be good for cash flow, but also means less activity in R&D. These are the costs of running the company's salaries, rent, legal fees, etc. For the 3 months, it went from about $1.8 million in 2024 to $1.9 million in 2025. A slight increase. For the 6 months, it's almost flat, around $4.1 million for both periods. This indicates they are managing their overhead costs reasonably well, or perhaps cutting back in other areas to offset increases here. This is the core operating result before interest, taxes, and other income. For the 3 months, their operating loss decreased from over $4.8 million in 2024 to about $2.5 million in 2025. That's a good improvement, meaning they lost less money from their core operations. For the 6 months, the operating loss also dropped significantly from nearly $9.8 million to about $5.6 million. A clear positive trend here. This is a bit technical, but it reflects changes in the value of certain warrants they have issued. In 2025, this line item shows a positive change of over $1.4 million for the quarter and nearly $940,000 for the 6 months. This is because the value of these liabilities decreased, which is good for the company's bottom line, as it means a reduction in their obligations. This decrease in liability is linked to their 2023 warrants expiring. This is the bottom line for the 3 months. Their net loss went down from over $3.4 million in 2024 to about $938,000 in 2025. That is a huge improvement, nearly an 80% reduction in their net loss for the quarter. For the 6 months, the net loss also decreased from over $6 million to about $4.3 million. While still a loss, this trend is definitely moving in the right direction. This translates the net loss into a per share figure. For the 3 months, it improved from a loss of 30 cents per S-Hair in 2024 to 6 cents per S-Hair in 2024 to 6 cents per S-Hair in 2025. And for the 6 months, from 53 cents per S-Hair loss to 27 cents per S-Hair loss. This shows that even though they are still losing money, the losses are becoming smaller for each share of stock. This statement shows the changes in the equity section of the balance sheet over time. This is a summary of their equity accounts at the 30th of September 2025. You see common stock, additional paid-in capital, which is money invested above par value, accumulated other comprehensive loss, and then a large accumulated deficit. The accumulated deficit is basically all the money they've lost since they started. It's over $224 million. This is typical for biotech companies that invest heavily in R&D before generating revenue. This statement is crucial as it tracks the actual cash moving in and out of the company. For the first 6 months of 2025, they used about $4.9 million in cash for operations. This is less than the nearly $7.8 million they used in the same period of 2024. This reduction aligns with the decreased R&D expenses we saw earlier. There is virtually no cash used in investing activities in 2025, which isn't surprising. They are likely not making large capital expenditures right now. In 2024, there was a very small investment of $15,000. In 2025, they used about $327,000 for financing activities, which seems to be related to stock issuance costs from their private placement. Looking at cash, it decreased from $22.1 million at the start of the period to $16.8 million at the end. This confirms they are spending down their reserves, but the decrease is less than the operating cash outflow because of the financing activities. These notes provide more detail and context for the financial statements. This note explains their corporate history, including name and jurisdiction changes. It's a bit of a journey moving from Canada to the US. This often happens for companies looking for better access to capital markets or more favorable regulatory environments. This is a critical section. They openly admit they have recurring losses and negative cash flow. They are a development stage company and they expect this to continue. This private placement in February 2025 brought in over $13.7 million. This was a vital cash infusion, helping them continue operations. And in October 2025, just after the reporting period, they got another $4 million from people exercising old warrants. This shows that the warrants they issued are still providing some cash, which is a positive sign for financing. This is what they plan to do with the money. They are gearing up for regulatory review, getting ready to sell GTX -104 if it is approved, and covering day-to-day operations. This section deals with how they value certain assets and liabilities, especially those that fluctuate in price. Here, they are valuing their derivative warrant liabilities. As of the 30th of September 2025, this liability is valued at $201,000. It's classified as a level 3 input, meaning the valuation relies on significant unobservable inputs, suggesting a degree of estimation and uncertainty involved. This number has decreased significantly from $1.1 million in March 2025, which is positive as it reduces their obligations. They have preferred stock authorized but none issued, which simplifies things. Common stock numbers match what we saw earlier, with an increase in shares outstanding reflecting the recent private placement and warrant exercises. This details the private placement that happened in February 2025. They sold shares and pre-funded warrants. The price was $3.395 per S-share for new shares and a nominal price for pre-funded warrants, which are essentially shares bought at a discount. This summarizes their earlier private placement in September 2023, which brought in over $7.3 million. This explains why some warrants are classified as liabilities. It's a technical accounting rule based on how the warrants are structured and whether they meet certain criteria. This discusses their stock-based compensation plans. They have an incentive plan that allows them to grant stock options and other equity awards to employees and executives. This is a common way to attract and retain talent, especially in the competitive biotech industry. This shows they have about 960,000 shares still available to grant under their incentive plan. This shows the expense related to stock compensation for R&D. It's a relatively small number, less than $130,000 over 6 months. And here, stock-based compensation for general and administrative staff. This is a bit higher, about $380,000 for the 6 months. Total stock-based compensation expense is around $508,000 for the 6 months of 2025. This means about $500,000 of future compensation costs are still to be recognized as these options vest over about a year and a half. Here they explain that because they have losses, diluted loss per S-share is the same as basic loss. Per S-share as any potential stock options or warrants would only make the loss appear larger if included. They list outstanding options. For 2025, there are over 1.3 million options and over 2.5 million common warrants from the 2023 placement. These are potential shares that could be issued, increasing the total number of shares outstanding in the future. This section breaks down their business into segments, but in this case, they have only one, which is not surprising for a company this size focused on drug development. This confirms their sole focus is drug development and commercialization. This shows their spending on clinical programs. For the 3 months in 2025, it's just $81,000, a huge drop from $2.66 million in 2024. And for the 6 months, it is down from $5 million to about $500,000. This confirms that major clinical trials, likely for GTX -104, have wound down or are completed, leading to a significant reduction in R&D spending. Professional fees like legal and accounting are staying relatively high, especially for the 6-month period, possibly related to corporate restructuring or the private placement expenses. This positive income is mainly from the change in fair value of derivative warrant liabilities, which we discussed earlier. They are not recording any income tax provision in 2025, but in 2024 they benefited from a tax credit. This is likely due to their accumulated losses and the complexity of tax regulations for R&D companies. This is where the company tells its story in its own words, explaining the numbers and the business strategy. This reiterates their core focus, developing and selling drugs for rare and orphan diseases using advanced delivery methods. This is a major milestone. They submitted their application for GTX-104 to the FDA in June 2025. This means they believe their drug is ready for market approval. And even better, the FDA accepted it for review. This is a huge step. The PDUFA target date of the 23rd of April 2026 gives them a timeline for when a decision could be made. This is the make or break moment for GTX-104. They have also secured strong patent protection for GTX-104, extending out to 2043. This is vital for protecting their investment and securing future market exclusivity. The Strive-On trial was very important. They announced in February 2025 that it met its primary goal and showed GTX-104 had a slight edge over the oral version of nimodipine in managing hypertension. This data is what they used for their NDA submission. This is a striking statistic. The bioavailability of the oral nimodipine was only about 7%, while their injectable version, GTX-104, achieved 100%. This means they can potentially use a much smaller dose of the drug with GTX-104 to get the same or better effect, which is a significant advantage. Their plan for selling GTX-104 involves a specialized sales team targeting hospitals. They are also open to partnerships to expand their reach. The market for GTX-104 is for about 42,500 patients diagnosed with ASA in the US each year. With global estimates higher, it indicates a significant market if their drug proves successful. GTX-102 is positioned as a potentially first-in-class treatment for children with ataxia telangiectasia. GTX-101 is a spray for nerve pain after shingles. Its unique delivery could offer relief for up to 8 hours. They are following United States Generally Accepted Accounting Principles, or GAAP, which is the standard for financial reporting in the US. Again, highlighting their assets, over $16 million in cash and nearly $50 million in intangible assets and goodwill. This shows a company heavily reliant on its intellectual property and future potential rather than current sales. Their net loss figures show a significant improvement. The loss for the 3-month period dropped by almost $2.5 million, and for the 6-month period by over $1.7 million. This is directly tied to the reduced R&D spending, especially on clinical trials, as major programs like the GTX-104 Phase 3 trial have been completed. They explicitly point out that the reduced loss is mainly due to lower R&D costs. The change in warrant liabilities also contributed positively, while administrative expenses ticked up slightly. This table clearly illustrates the R&D cost reduction. Third-party R&D expenses plummeted from over $2.7 million in the first 3 months of 2024 to just $201,000 in 2025. This is a massive reduction, indicating a major shift in their R&D activities. Salaries and benefits for general administrative staff have slightly decreased, which is a good sign of cost control. Professional fees did see a decrease in the 6-month period. This might reflect the completion of some legal or consulting work related to previous corporate changes. They explain that the change here, a positive one for the company, is largely because their 2023 warrants are nearing expiration. As their expiry date gets closer, their valuation changes, and in this case, it reduced the company's liabilities. This section focuses on their cash situation and their ability to fund future operations. Reiterating their cash position, they have about $16.8 million. This is a decrease of over $5 million from the prior quarter. This is their runway estimate. They think they have enough money to operate for at least another year. This is a crucial statement for investors. The cash outflow for operations decreased significantly from nearly $7.8 million in 2024 to about $4.9 million in 2025. This aligns with their decreased operational expenses, especially in R&D. They mention again the $13.7 million raised from the February 2025 private placement, underscoring its importance for their liquidity, and the earlier $7.3 million raised from 2023. These events are critical for understanding how they have funded their operations. The company states their internal controls are effective. This is standard for SEC filings and means they have systems in place to ensure accurate financial reporting. Good news on the legal front, they report no current legal proceedings that are expected to significantly impact the company. They haven't added any new major risks since their last annual report. This implies the risks they previously disclosed remain the primary concerns. There was an amendment to the CEO's employment agreement in November 2025. It lays out terms for his compensation and benefits if his employment is terminated, both with and without cause, and especially in the context of a company sale, a so-called change in control. Similar to the CEO, other key executives like the Chief Financial Officer, VP of Program Management, VP of Clinical Operations, and Chief Medical Officer also had their employment agreements updated or put in place in November 2025. These agreements detail their salaries, bonus potential, and severance packages. It signals a period of solidifying leadership and their terms as the company progresses towards potential product launches. This is just a list of all the legal documents and agreements attached to the filing, nothing to analyze here. So, what is the story here? Grace Therapeutics is in a precarious but potentially exciting position. They have a primary drug candidate, GTX-104, that has submitted its application to the FDA and is awaiting a decision. This is a massive hurdle they are attempting to clear. Their financial situation shows they are burning cash as expected for a biotech firm, but they have managed to reduce their spending, particularly on R&D, which is a positive sign for their operational efficiency. The cash they raised through private placements and warrant exercises is keeping them afloat and allowing them to prepare for a potential launch. However, the heavy reliance on GTX-104 is a significant risk. If it doesn't get approved, their path forward becomes much more uncertain. The fact they are a smaller reporting company means they still have a long way to go to achieve consistent revenue and profitability. Their other drug candidates are deprioritized, meaning their entire focus and future really hinges on GTX-104. My take is that Grace Therapeutics is a classic biotech gamble. The potential reward if GTX-104 is approved is huge, given the unmet needs in the ASA market and the advantages their formulation might offer. But the risk of failure is equally substantial. They have made smart moves by securing IP and managing costs, but the ultimate outcome depends entirely on the FDA's decision. Investors need to be aware of the high-risk, high-reward nature of this type of investment. Overall, Grace Therapeutics is navigating the challenging landscape of drug development with focus and a clear strategy on their lead candidate. The coming months will be critical as they await the FDA's verdict on GTX-104. What are your thoughts on Grace Therapeutics' progress? Do you think GTX-104 has a good chance of approval? Let us know your insights in the comments below. If this deep dive was helpful, please give this video a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community. The link is in the description for more discussions and to connect with other curious minds. Thanks for watching, and we'll see you in the next video.